Savings and investments are directed through capital markets between suppliers, people, or institutions with resources to lend or invest in those in need. Banks and investors are common suppliers, whereas enterprise, governments, and people seek funds. The primary and the secondary markets make up the capital markets. The stock market and the bond market are the two most frequent financial markets. Capital markets are always striving to improve transactional efficiency, and these markets bring providers and people looking for finance together and provide a venue for them to trade security.
There are three key takeaways in understanding capital markets. First, capital markets are places where money are traded between those who supply capital and those who demand capital for the consumption. New securities are issued and sold in primary capital markets, while the secondary market is where investors exchange previously issued securities. Lastly, the stock and bond markets are the most well-known financial markets.
The capital market are divided into two categories, primary market and secondary market. The primary market, when a corporation sells new stocks or bonds publicly for the first time, such as through an initial public offering or IPO. It is doing so in the primary capital market. This market is also known as the new issues market. When investors buy securities on the primary capital market, the company that sells them employs an underwriting firm to assess them and prepare a prospectus explaining the pricing and other features of the securities to be sold.
The secondary market, on the other hand, consists of venues supervised by regulatory agencies such as the SEC, where previously issued security are exchanged amongst investors.
The secondary market has two different categories, the auction and the dealer's market. The open outcry system, in which buyers and sellers assembled in one spot and proclaim the prices at which they are prepared to purchase and sell their securities, is used in the auction market. On the other hand, in dealer's market, they're using electronic network. The majority of small investors transact through dealer's market.
There are two types of capital markets. First is the equity security. Equity securities, which are effectively ownership shares of a firm and therefore and traded on the stock market. When you own a firm's equity securities, you effectively own a share of the company and are entitled to earn future earning that the company generates. The money you invest in equity securities on the hand is not obligated to be repaid by the corporation. Second is the debt securities. Debt securities are IOUs that can take the shape of bonds or notes and are exchanged on the bond market. They essentially reflect the borrowing of money that will be repaid with the interest of later period. IOUs is usually an informal documents acknowledging the debt.
Capital markets are financial markets that connect buyers and sellers of stocks, bonds, currency, and other financial assets. The stock market and the bond market are examples of capital markets. They assist people with ideas in becoming entrepreneurs and small firms in growing into large corporations. They also provide possibilities for people like you and me to save and invest for our futures.